He said he was thinking 300 years ahead. He had $100 billion to invest. He changed how money flows into technology globally. Then the companies began revealing their real values. 27 billion lost in a single year. One of the largest investment losses in history. This is the SoftBank Vision Fund. He said he was thinking 300 years ahead, and the people in the room believed him, and they gave him $100 billion, and it became the largest technology investment fund in history, and it changed the way money flowed into technology companies around the world, and it made some companies extraordinarily wealthy, and it made some founders extraordinarily reckless, and it made the vision of a Japanese entrepreneur the dominant force in global technology investing for several years. And then the companies in which it had invested began to reveal their true valuations, and the losses began to accumulate, and by 2022 the SoftBank Vision Fund had recorded one of the largest investment losses in history, and the story of how it happened reveals something important about what happens when too much money pursues too few ideas, and when the size of an investment becomes the argument for its wisdom. Masayoshi Son is one of the most remarkable figures in the history of technology investing, and his story before the Vision Fund is itself extraordinary. He founded SoftBank in 1981 at age 24 and built it into one of Japan's most important technology companies, and in 2000 he made what is widely regarded as the greatest venture capital investment in history when he invested $20 million in a small Chinese company called Alibaba that would eventually become worth hundreds of billions, and Son's stake would be worth tens of billions, and this one investment transformed SoftBank from an important Japanese company into one of the wealthiest technology investors in the world, and it gave Son a reputation for seeing the future that was almost mythological in the technology industry. In 2016 Son met with Crown Prince Mohammed bin Salman of Saudi Arabia, and in 45 minutes he convinced him to commit $45 billion to a new technology investment fund, a pace of approximately $1 billion per minute of conversation. And with additional commitments from Abu Dhabi's Mubadala Investment Company and other investors, the SoftBank Vision Fund closed in 2017 with approximately $100 billion in committed capital, more than twice the size of any technology investment fund that had ever existed before. And Son announced that the fund would invest across artificial intelligence and robotics and the Internet of Things and autonomous vehicles and the connected future that he was certain was coming. The size of the Vision Fund changed the dynamics of technology investing in a fundamental way, and because the fund had $100 billion to deploy, and because it needed to deploy large amounts to make a difference to fund-level returns, it could not invest 20 or 30 million in promising early-stage companies in the way traditional venture capital worked. It needed to invest hundreds of millions or billions in each company, and this meant it was almost exclusively investing in late-stage companies that already had significant revenues and valuations, and the effect of this was that when SoftBank offered to invest billions in a startup, the startup's founders faced an unusual choice. They could take the money at a very high valuation which would allow them to grow aggressively and expand their ambitions, or they could decline and risk a well-funded competitor receiving the SoftBank money instead. And many founders took the money, and the consequence was that Vision Fund money created an arms race of growth at any cost thinking in the companies it backed. The most celebrated and most catastrophic example of this dynamic was WeWork, and the office-sharing company run by Adam Neumann received investment from SoftBank at a valuation that eventually reached $47 billion, and Son was personally convinced that WeWork was not a real estate company but a technology company that would transform how humanity worked, and he encouraged Neumann to think bigger and bigger, and the company expanded aggressively into dozens of cities, and the losses accumulated. And when WeWork attempted to go public in 2019, investors examined the IPO prospectus and concluded that the company was worth a fraction of its stated valuation, and the IPO was withdrawn, and SoftBank was forced to inject additional billions to prevent WeWork's collapse, and the total investment in WeWork eventually resulted in losses estimated at over $14 billion for SoftBank. WeWork was the most dramatic single example, but the Vision Fund's portfolio contained many companies whose valuations were built substantially on the expectation of continuing growth financed by continuing access to cheap capital, and when interest rates rose sharply in 2021 and 2022 and investors became less willing to fund loss-making companies at high valuations, the entire ecosystem of Vision Fund investments was stressed simultaneously, and the fund reported losses of $27 billion in the fiscal year ending March 2023. Making it one of the largest single-year investment losses in history. Other major Vision Fund investments that performed poorly included Katera, a construction technology company that filed for bankruptcy in 2021, and OYO, the Indian hotel chain whose valuation collapsed dramatically, and Zoom, a pizza-making robot company that shut down its core business, and Wag, a dog-walking app, and numerous other companies whose high valuations reflected the optimism of a period of unlimited cheap capital rather than demonstrated business fundamentals. Son himself acknowledged the losses with a level of candor that was unusual for someone of his stature. He publicly compared himself to a foolish person who had lost their way, and he acknowledged that the Vision Fund's investment approach needed to change, and in the period following the losses SoftBank shifted toward more conservative investing and Son redirected much of his energy toward artificial intelligence, which he continued to believe was the dominant technology of the coming decades. The Vision Fund story is not a fraud story in the traditional sense. Son did not steal from investors. The money was genuinely invested in companies that genuinely tried to build the businesses they had described, and some of those companies became significant and profitable, and the Vision Fund also backed companies like ByteDance and DoorDash and Grab that performed well. But the aggregate result of deploying $100 billion in the compressed time frame the fund required at the valuations available during the period of peak technology optimism was a set of losses that demonstrated something fundamental about the relationship between capital and value. So what is the real lesson of the SoftBank Vision Fund? And the lesson is that size is not a substitute for judgment, and that when a fund is large enough that it changes the market it is investing in, large enough that its arrival at a startup's door raises that startup's valuation simply by the fact of its interest, it has created a circular logic in which the investment itself inflates the value of what is being invested in, and this circularity is sustainable only as long as the capital keeps flowing, and when the capital stops flowing, as it inevitably must, the underlying valuations revert to something closer to the real business value, and the gap between the two is the loss that the fund records and that its investors absorb. The Vision Fund also demonstrated what happens when the pressure to deploy capital at scale collides with the limited number of genuinely transformative investment opportunities. Not every company that received Vision Fund money was a future Alibaba. Some were businesses with real problems and limited addressable markets, and the pressure of $100 billion to deploy meant that the fund could not afford to be as selective as the quality of its investments required. That is the capital case. Subscribe to the capital case because the next case is already waiting.